What's up, everybody? Welcome back to Trades and Gains. I'm your host, Max Pitts, and we are live right now currently over on Twitch, over at Free Wi-Fi Radio, with that O in radio as a 0. So feel free to come and hang out with the community over there that we have. And as always, this is powered by Investor Central Club, the best options flow software that you can get on board with. And if you use that code SUPERMAX20, you get 20% off your first month. But today, we're here to talk about PCE. Tomorrow isn't just another inflation print. It's not CPI, and it's not some second-tier data drop. It's Core PCE, which means tomorrow's basically a referendum on whether this entire soft landing with cuts narrative gets to survive that the Fed has been throwing around. Or is this going to get thrown out the window like your 2022 growth portfolio at this point? The markets, they're currently pricing 60 to 75 basis points of cuts in 2026. The first cut is leaning towards June/July as of right now, and there is a non-trivial chance of 3 cuts. And tomorrow is where all of those priced in actions are going to get stress tested. So today we're going to go ahead and break down what PCE actually is, because let's be honest, 95% of Twitter doesn't know, why it matters more than CPI, and 3 scenarios for tomorrow. We're also going to talk about what happens to SPY, QQQ, IWM, yields, and the dollar. And finally, how to think about positioning without absolutely losing your mind. So let's go ahead and dive into this. And by the way, we are only 2 subscribers away from 1,000 subscribers on the channel over here. So what should we do for 1,000? Top comment, we'll go ahead and do it. So first of all, PCE, let's talk about what it means. It stands for personal consumption expenditure, okay? Core PCE is the Fed's preferred inflation gauge, not CPI, okay? CPI is what headlines scream about. PCE is what Powell actually cares about. Now, you're probably sitting there wondering, well, why? Well, because PCE adjusts for substitution. So if steak is expensive, you buy chicken. It gives more weight to services. It includes healthcare more realistically, and it runs about 0.3 to 0.4% cooler than CPI historically. So when CPI prints 3.2%, PCE might be 2.8%. That's why the Fed's 2% target is explicitly in core PCE terms. And right now, November core PCE is expected at 2.8%, and the consensus for December is 2.8 to 3%. Month over month is expected at 0.2% to 0.3%, but some desks are whispering could be a 0.4% if tariff pass-through is stronger. And that's where things get, let's just say, interesting. Now, we just had CPI that looked pretty friendly. Year over year was around 2.4%, and month over month was over 0.2%. The markets liked it, but if PCE comes in hotter, that's the Fed's scoreboard saying, nice CPI, but as Kobe Bryant would say, job's not done. So let's start with the one everyone on FinTwit currently wants. The dovish / risk on, all right? Data looks like core coming in month over month at less than 2% or equal to 2.2%. Core year over year is coming in at 2.7 to 2.8%. And headline comes in or at 2.7 to 2.8%. Basically, disinflation is back on the menu. CPI wasn't a fluke, and the Fed can finally unclench its butt cheeks and exhale. The market reaction is we would see the 2-year yields drop, 10-year drifts lower, the real yields will actually fall, and the curve bull steepens in this case. Translation, lower discount rates equals higher multiples for these out of price companies. On SPY front, we're going to be broadly bullish. We're going to see multiples expanded, and we're going to see the cyclicals finally catch a bid. QQQ, this is the sweet spot of this. Lower yields plus cut expectations. That means you can just throw AI 20 times onto a PowerPoint and people will just blindly give you money. That's the reality, all right? AKA, let's buy AI again. This is peak environment for long duration growth. On the IWM front, small caps, they get a benefit here too, because as I tell my class every day, who are the real winners in a rate cut environment? IWM, because why? They're poor. So they can't afford these 20-year high yields that, well, aren't doing anything for them, right? So, yeah, if PCE is soft and GDP looks okay, guess what? IWM could rip, boys. Absolutely rip face. Now, the USD, the dollar would go ahead and weaken, and, well, risk assets finally can begin to breathe a little bit. Now, the narrative line here is the economy is cooling just enough to let inflation cooperate, but not enough to break earnings right now. And that is the key here, right? So that's the Goldilocks sequel, soft landing 2.0. And that's when volatility sellers come back out like they never left. Now, the scenario 2 is inline, numbers coming in line, and it turns into a trip to Benihana, aka Chop Fest. And this is the least sexy, but to be honest, the most likely. On the data front, we'd see core month over month coming at 0.2 to 0.3% exactly, core year over year to come in at 2.8 to 2.9%, and headline to come in at 2.8 to 2.9%. Basically, this is telling us it's sticky but not breaking. No major information shock. In the market reaction, they're going to go nuts for about 30 minutes, and then we basically just go sideways because nothing changed, and that is already priced in, right? The Fed stays, and they will say, we will deliver cuts, but they're going to happen slowly. June, maybe, maybe not. SPY, it's basically going to chop. QQQ is going to get stuck in a range with no new tailwind and no new shock. IWM trades more on growth data than inflation data at the end of the day. And the trading angle, this is classic. Fade the first move, because if there's no true surprise, positioning drives the action, not fundamentals at that point. Now, scenario 3 is hot PCE, aka a reinflation scare. So this is the one markets are quietly sitting and biting their fingernails and clutching their purse strings about. Data comes in, core month over month comes in at 0.3% to 0.4%. Core year over year comes in greater than 3%. Headline is near 3%. And now we've got a problem because CPI looked better. It looked sexier. It was like that hot tennis assistant that you're going to ultimately cheat on your wife with. But the Fed's preferred gauge is reinflating. Now, that narrative becomes the last mile here is sticky. On the market reaction front, the 2-year yields will spike, the 5-year spikes, the 10-year tests highs, and real yields go up. And when real yields go up, long duration assets get punched in the face. QQQ, and no, I'm not talking about the TV show, would be the biggest loser. High multiple tech, speculative growth, AI names trading on 2030 cash flows, meaning they're trading purely on hopium and that the Galaxy gas is locked and loaded at your local smoke shop. All of that is going to go ahead and get repriced at that point. SPY, it would be negative, but maybe cushioned by financials at the end of the day. IWM also is very vulnerable here. Higher yields plus tighter financial conditions Well, that's just bad for levered small caps. And the dollar, it would be stronger, which pressures global risk assets. Now, the good news, inflation's not alive. The bad news, rate cuts, well, they're definitely not. That's when markets start repricing from 3 cuts possible to maybe 1. And that's when volatility finally comes out of hibernation. So here's the real question. This isn't just about one print. It's about which regime we're in. Are we in gradual disinflation plus cuts, sticky inflation plus patience, growth slowdown plus forced easing? Tomorrow, unfortunately, will not fully decide that for us, but it absolutely will nudge the probabilities. And markets right now are priced for controlled glide path. If PCE cooperates, risk can grind, and if it doesn't, well, discount rates reprice. And when discount rates reprice, multiples move faster than earnings ever do. So Core PCE is the Fed's scoreboard. That's the way to look at this. There's no denying that. Tomorrow is going to go ahead and decide whether markets keep pricing a gentle glide path or whether we dust off the higher for longer playbook again. So don't trade the headline, trade the reaction. And more importantly, watch the yields, because tomorrow isn't about inflation, it's about discount rates. And discount rates, at the end of the day, decide everything. This is Max Pitts with Trades and Gains, powered by Investor Central Club. Again, use that code SUPERMAX20 for 20% off your first month. And I will see you guys tomorrow for my PCE recap. Again, don't trade the headlines, trade that reaction. Make sure you like, subscribe, comment down below. Scenario 1, 2, or 3, which one are we getting? What do you think? I'll catch you guys in the next video, and I hope you're having a great rest of your Thursday.